All right, let's talk about Chevron. It's obviously one of the biggest names in energy, but right now its stock chart is telling a really fascinating story. What we've got here is a classic tug of war. You've got this incredibly powerful momentum on one side, but it's running head on into some pretty serious warning signs. So let's dive in and unpack what's really going on here. So as we're looking at this, the stock's trading at $155.90. Now that number by itself doesn't tell you much, but it's where that price is sitting that makes this whole thing so interesting. See, that price is the result of a very powerful and very recent move to the upside. And this really gets us to the million-dollar question for today. Are we looking at a genuine, sustainable breakout that has more room to run? Or is this a rally that's just getting way too overextended and is basically running on fumes? As you're about to see, the data is pointing in two completely different directions at the exact same time. Okay, so let's start with the obvious story here, the bullish breakouts. I mean, on the surface, things look incredibly strong, and it's easy to see why people are getting optimistic. The price hasn't just been climbing, it has absolutely surged higher. It's now trading at the very, very top of its recent range. It's even pushed past its upper Bollinger Band. Now, for those who don't know, think of Bollinger Bands as guardrails that usually contain the price. When a stock jumps outside of them, it's a sign of some serious short-term strength. So, what's actually fueling this bullish case? Let's break down the specific data points that have the optimists feeling pretty good about Chevron right now. First off, the stock's overall posture is just clearly bullish. You can see the current price is sitting comfortably above both its 20-day and its 200-day moving averages. This is classic technical analysis 101. It tells us that both the short-term and the long-term trends are pointing up. The buyers are in charge. But hey, a trend is one thing. The momentum behind that trend is a whole other story. And on that front, the bulls have another really key piece of evidence on their side. A very widely watched momentum indicator has just flashed a big green light. We're talking about the MACD, the Moving Average Convergence Divergence. And the key thing to see here is that the MACD line has just crossed above its signal line. This is what's known as a bullish crossover. And it suggests that the upward momentum isn't just there, it's actually picking up speed. Okay, so the case from our upside seems pretty solid, right? Well, this is where our story takes a really sharp turn, because hiding just beneath that powerful surface, there are several warning lights that have started to flash. And believe me, they are flashing brightly. And this slide just perfectly captures the conflict. On one hand, you've got the Arun indicator, which is maxed out at 100. All that means is the price just hit a brand new high, a clear sign of a powerful uptrend. But then you look at the average directional index, the ADX, and it's at a super low 1230. Anything below 20 on that indicator suggests the trend is actually weak, or maybe not even a real trend at all. So you have the price screaming higher, but the engine behind that move seems to be sputtering. You know, a really good way to think about this is like you're flooring it down the highway. The speedometer says you're going fast, which is great, but the dashboard is lighting up like a Christmas tree with warning lights. The speed looks impressive, but it might not be sustainable. This is exactly what traders mean when they say a stock is overbought. And those warning lights, they just keep coming. The stochastic oscillator, which is a key momentum gauge, is all the way up at 96.65. Now, for context, any reading over 80 is considered overbought. So at almost 97, this thing is deep in the red zone. And it gets even more extreme from there. The stochastic RSI, which is an even more sensitive version of that same indicator, is at 100. That's its absolute maximum value. It literally can't go any higher, which suggests that the buying pressure might be totally and completely exhausted. And just to really hammer the point home, the Williams R% indicator is also at its upper extreme. It's another classic, powerful signal that the stock is severely overbought and could be vulnerable to a pullback. So you might be thinking, okay, the momentum is stretched, but what about the conviction from buyers? Well, that brings us to the final piece of this cautionary puzzle. See, when a stock makes a huge move like this, you really want to see a massive surge in trading volume to prove that it's the real deal. And here, we're not quite seeing that. This chart shows it pretty clearly. The trading volume on the day of this big price spike was actually below its recent average. A breakout on low volume is always a little suspect, and it makes you question whether the move really has enough fuel to keep going. So there you have it. We have two completely different stories being told by the data. On one side, you have this powerful, undeniable momentum. And on the other, you have all these clear signs of exhaustion and a real lack of conviction. Let's put them side by side for the final showdown.
The analysis we're drawing from just sums it up perfectly. This is a classic momentum versus exhaustion scenario. It's like the irresistible force of this price surge is meeting the immovable object of these overbought technicals. So here's the bottom line. The bullish case is all about the here and now. The price action and the momentum are strong. But the cautionary case is all about what might happen next. You've got oscillators screaming exhaustion, a weak underlying trend, and pretty unconvincing volume. So given this huge technical tug of war, we can't really predict who's going to win. But what we can do is identify the battlefield. We can look at the specific critical price levels that are probably going to decide the outcome.
Yeah, the next chapter in Chevron's story is going to be written by how the price acts around a few key levels. These aren't just random numbers. They're calculated right from the stock's recent trading, and they represent major potential turning points that everyone's watching. And here they are. Think of this like a price ladder. At the very top, you have resistance at 157.45. That's the ceiling the bulls need to break through. Down at the bottom, you've got support at 152.80. That's the floor the bears need to crack. And right there in the middle, you have what might be the most important level of all. And that level is the pivot point, sitting at $154.35. You can think of this as the fulcrum on a seesaw. As long as the stock stays above this level, the bulls keep the edge. But if it falls back below, that's a signal that momentum is failing, and the bears are starting to take back control. Which brings us right back to our final question. The stock is stuck in this critical battleground, above that pivot point but still below resistance. Is that powerful momentum we saw earlier going to be enough to shatter that ceiling? Or are all those flashing warning signs of exhaustion finally going to catch up and win the day? The levels are set, and the market is about to give us its answer.